What if I told you that in the next 2 years, your boring 401k account could have the same investments that made billionaires rich? Private equity, real estate, infrastructure. These investments used to be locked behind the velvet rope of wealth, but now they're becoming available to everyday Americans. I'm Terrell Higgins, and in a world filled with information, I'm giving you transformation. And Donald Trump signed an executive order that's going to transform how everyday Americans build wealth in their 401ks. Most people don't even know this change happened. And while they're still investing in the same 3 index funds, after you watch this video, you'll be prepared to invest in these new investments, take advantage of them, and build wealth like the billionaires already have. Let's get into it. For decades, there's been a 2-tier investment system in America. Regular people get access to stocks and bonds in their 401k accounts, and the ultra wealthy have access to private equity, real estate developments, infrastructure deals, things that can actually build generational wealth. And do you think the Yale and Harvard endowment funds are investing in the S&P 500? No, they're buying startup companies, infrastructure deals, private equity deals, and building massive amounts of wealth. And for the longest time, you cannot buy into these investments unless you're already wealthy. It's the equivalent of saying you can't buy a Ferrari unless you have enough money to buy 10 Ferraris. But with this new executive order, all of that changes. On August 7th of 2025, Trump signed an executive order called Democratizing Access to Alternative Assets for 401k Investors. It's a fancy name, but all it means is that the Department of Labor and the SEC have to figure out how to give average day Americans access to these investments in their 401k accounts. And they rescinded the guidance that was blocking these investments in 401k accounts within 5 days, but it's still going to take time for them to actually roll out the rules and for your actual plan sponsors to adopt these investments into their accounts. So we're about 2 years out from you being able to invest in these new investments. So what investments are we actually talking about here? So there's 6 kind of broad categories of investment types that we're discussing. So private equity, not to be confused with venture capital. Private equity is buying mature companies, improving their efficiency and profitability, and returning that profit to investors. Where venture capital is buying in a startup company and hoping it turns into the next Apple or Google. Those have very different return profiles and very different risk metrics. And then there's private credit. So private credit is where you actually lend money to businesses, they do their operations, and they return that loan to you with interest. Then we have real estate. So this is not to be confused with REITs that you can actually buy already. These are direct real estate investments in commercial properties. So apartment buildings, medical, storage, all these large commercial buildings, you can actually buy in directly instead of indirectly via REITs. Then we have commodities. So this is buying into agriculture, oil, gold. These things tend to zig when the economy zags. So if the overall economy is down, commodities actually have a tendency to outperform. And now you can buy those directly in your retirement account. Then we have infrastructure. So think roads, think bridges, think data centers. These are the backbone of the US economy. And next time you're stuck in traffic, just think, you could actually own that highway that you're stuck on. Then we have digital assets. Yes, I am talking about crypto, but don't think you're going to be buying Dogecoin in your retirement account. It's probably going to be some bundled fund with various crypto exposure and not a single cryptocurrency. And the final product are income products. So these are like annuitized annuity products. So annuities have existed for a long time, but now you can buy annuities directly in your 401k account to help limit risk and produce recurring income in your 401k. Let me know in the comments below which of these investments you're the most excited about. So let's talk numbers here. So what kind of returns can you expect from these alternative investments? So I will caveat this by saying these results will vary significantly depending on the strategy that you employ and the actual operator who's employing the strategy. So when these options roll out into your 401k account, you're going to have to do your homework to actually find the best returns. But on average, if you're doing private equity, you can expect between an 11 and 13% return. So that's competitive with the S&P 500. And sometimes it outperforms and sometimes it's about the same. And then if you're buying into infrastructure, we're talking an 8 to 10% return. Private credit is an 8 to 10% return. Real estate is between 5 to 7% returns a year. And then for digital assets and commodities, they're very volatile. It's feast or famine. It could go either way. So you want to limit your exposure to these products in your 401k account. You don't want to blow out your account by overinvesting in those last two assets. But like I said, these averages hide the dispersion between operators. The top quartile private equity firms crush it. They absolutely destroy the performance of the S&P 500, while the lower quartile significantly lag the performance of the S&P 500. So you're really going to have to do your homework on these alternative assets and the specific operators when they start rolling out into your 401k. So none of these investments are some magic bullet that's going to make you wealthy overnight. But the big thing that they give you is diversification. You are diversified out of the standard S&P 500 returns. So if the market is going down, you could still be getting about market returns without that correlation to the market. So that diversification is very powerful and makes your returns more consistent and lets you sleep easier in retirement. So what does the timeline actually look like for these new options becoming available in your 401k account? Don't go logging in tomorrow expecting to see private equity options sitting there. So the Department of Labor owes the guidelines by February of 2026. So the whole market will have to digest what these new rules and regulations look like. And then by late 2026, you should see like the BlackRocks and the KKRs of the world actually developing products around those new rules. And it's kind of like the iPhone launch. Everyone knew it was coming, but it took time for them to actually put it together. So the earliest you could see this is mid-2027. And it could still get delayed later than that, depending on shifts in the market and potential litigation. So just because these products roll out doesn't mean your employer is actually going to offer them. And there's a few good reasons why. The first one is fees. So the fees on these type products are between 1 to 2%. And if you compare that to an S&P 500 index fund, which is about 0.26%, that is a huge difference in fees compounded across a 20 to 30 year career. So if the returns are lagging the S&P 500 and have significantly higher fees, your employer has a hard time justifying offering these products to you. The other thing is the complexity. So a lot of these investments have a lockup period. Your funds are illiquid for some period of time where you cannot pull the money out. And in a 401k account, everyone is expecting liquidity. They're expecting in retirement or leading up to retirement, they can withdraw those funds at any point that they want. And that structure, that illiquid structure, It kind of smooths what the risk profile looks like because private equity companies only report quarterly, but they are just as volatile as stocks. The up and down from day to day can be just as bad as owning straight up equities, but it's hidden because of how they currently report. So they're going to have to revise the way they actually mark to market their investments. And they're going to have to revise the way that they allow liquidity in and out of their investments. And the biggest thing, and this is huge, is they don't want to get sued. If you put your money in these investments and they start tanking, then they could be sued by you because they're not meeting their ERISA standard. They're acting as a fiduciary for you and providing investments that are in your best interests. So if they put a bunch of investments in your retirement account that have the potential to take you to zero, that opens up liability for your company. So they still might not offer all of these investments. So for the employers that actually embrace these alternative investments, they're opening up a huge opportunity for the employees. Think about it. Right now, all you can invest in is the stock market and bonds. But with these new investments, all your eggs aren't in one basket anymore. If the stock market is going down, maybe real estate's going to hold steady. If inflation starts to climb, then commodities tend to surge. If interest rates spike, then private credit markets tend to respond. You aren't tied to just getting public market returns, and you can hedge risk in a much more efficient manner. So you can smooth your returns going into retirement and through retirement and rest easier that all your eggs aren't in one basket. So what should you do right now in preparation for all of this? Make sure you're contributing in your 401k up to the match so you're taking advantage of all those free dollars. Don't wait for all these new investment types to come out to take advantage of what's already in front of you. And then you need to educate yourself on these alternative investments. They all have different risk profiles, different return profiles, and you need to figure out what matches your risk tolerance and fits into your portfolio. And if you're having trouble with that, don't be afraid to sit down with an expert. I prefer a fee-only fiduciary advisor as opposed to a 1% assets under management advisor. And I will leave a link down below of where you could find one of those. But this is not about chasing returns. It's about managing risk in your portfolio. So you have to know what you're invested in. So the last thing you can do is just keep up to date with how this legislation actually gets rolled out. And like I said, in February of 2026, the Department of Labor is going to be giving its actual guidelines. And I will definitely do content around the actual rules and how it's going to impact your 401k. So feel free to like and subscribe to the channel, and I will keep you up to date. But the biggest thing with all of this is you don't want to put all your money into these alternative assets. It's about managing risk. By putting some of your investments into these alternative assets, you'll assume less risk than if you were just in public markets. And for the longest time, only the ultra wealthy and private funds were able to do this. This diversification of your risks and diversification of assets is going to be a game changer for managing risk in your 401k. And you may have noticed that my background's a little different today. I took you guys on vacation. Hopefully you guys are enjoying your summer as much as I am. Keep getting 1% better every day, and I'll catch you guys next time.